Good morning, everybody. It's Wednesday, August 28th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here, December corn down 2 3/4 at 390. November soybeans were down 10.5 at 976, and December Chicago wheat was up a half at 536. This morning, excuse me, the USDA announced export sales of 264,000 metric tons of soybeans to China for 24, 100,000 metric tons of corn to Colombia for 24, and finally 165,735 metric tons of corn to Mexico for 24. We also, before we dig in here this morning, we had some comments from a viewer yesterday after the show. I'm going to read those comments, and then I think it'll ignite a little bit of conversation here from the guys here. So a couple of points to make. The China-dominated port in Lima, Peru, slated to open in late 24 and be fully operational in early 25. This viewer suspects the agricultural transportation costs would be competitive and make Seattle and Long Beach look expensive. Second point, the discussion on input costs in Brazil, referencing our discussion we had yesterday. How do we know what their costs are if the countries are bartering and using local currencies? The change in how the U.S. dollar is used internationally is making analysis more complicated. And finally, if the BRICS are a trading consortium and are poorer countries, is their alliance stronger basically to dictate buying over lower cost prevailing? As an example, will China pay 1 to 5% more than the U.S. price to support that alliance with Brazil, Argentina, and the Peru port? And China can pay with lower cost, high value tractors and not U.S. dollars. So quite a bit there. Justin, maybe a few thoughts to kick us off relative to those comments, and then we'll throw it around the room.
Yeah, it's a lot for a morning question. Very good questions, for sure. I would say yes. I think we've seen that trend in general already. We've seen hundreds of billions of dollars pumped into South America, Africa, Russia by the Chinese for those exact reasons, right? To secure their supply chains. They're obviously a huge agricultural importer. So we've seen that trend for a long time. We've known about, they've been building highways and rail and ports and tons of infrastructure in South America. So yes, I agree. I think it's pretty obvious at this point that we are, the last resort, the country of last resort. The production of South America has skyrocketed. These countries are in debt to China. They're giving, cheap financing to build these projects over the last couple decades, really. And I think absolutely that's the case. We're going to have a tough time competing against that. Now, at the end of the day, if we're the cheapest, they'll buy it from us. But by making those kind of investments. When I went down there in 2009 to Brazil, and I was in, really far in the interior, and it cost $2 a bushel to truck, and all the beans were going. It was about a 20-hour trucking trip to get to the port. That's the only infrastructure they had at the time in 2009, and it cost about $2 a bushel to get it from that farm to the port, right? So every time you can improve that, and they were still making money, right? They were still expanding, even though it was costing them $2 a bushel to get it to where they had to sell it. So that's been 15 years. So as infrastructure improves, they've made locks and dams that they can use the Amazon more efficiently. So all these kinds of things have been adding up. So as you do that, they already had a competitive advantage even with all those infrastructure issues. Now you improve that. I agree. I think it's really going to be a really tough thing to overcome. And on the show, I think that's why we've talked about, my opinion is that we have to domestically use most of our supplies because it's not a level playing field With the kind of cost structure that we have here in the U.S., I think it's going to be really tough to compete globally with South America. I think if we're going to have these initiatives and these things that, going green, whatever you can call it, BS or not, or you be pro or con, at the end of the day, if we're going to do these things, I think we need to use our stuff domestically. Stop, cut off imports. We can't make the U.S. do this and also allow China to dump used cooking oil on our market, for example, right? So I don't know if that answers the question, but I would say, yeah, 100% agree. I mean, that is going to be a problem. And I do think they will, they already do pay a little premium for soybeans, for example. China does for South America because it's a little higher protein content. So it's got a little bit of a higher crush value because of the meal component. So there already is a little bit of that that they will pay a premium. But if you add in some of these other things, I 100% agree.
Yeah, and I'll just add a couple things too, just some of the details of it's not a lot of great data out there of what Brazilian cost of production is. But for example, CRA and real estate Brazilian investors have been battered here. There's a Bloomberg article a couple of days ago just showing the number of bankruptcy filings have doubled from fourth quarter 2023 to first quarter 24 in Brazil. And then we also, there was a survey around that same time, first quarter 24, is something like 87% of the respondents in the survey in Mato Grosso reported that they were not above cost of production. They could not break even in soybeans at the time. So I just think hints that we are, and of course, bean prices have dropped dramatically since then in real. So I think that there's some telltale signs that that's happening. I don't think the data is nearly as good as the U.S. Does that mean that their production is going to slow? Probably not. Once you have the infrastructure built, somebody's going to farm that ground. Somebody's going to produce on that ground. It's not like it's just going to fall to the wayside. But some of the fringe ground in the U.S. we certainly see in lower production years. We see higher prevent plant. We see more acres, sitting fallow.
Hey, Dustin, to that point, I think we maybe talked about this. I don't know if it was internally or on the show, honestly. But the first thing you do is you start cutting back inputs, right? If you already have the ground, you've already cleared it, right? It's a 2 to 3 year process to take some Cerrado ground, clear it. You got to plant a couple different crops before the ground's suitable. You've done the expensive part. So if you have the ground, you're gonna plant, right? And you're gonna, what you would do is you would cut it back on inputs, right? It's the same, I think, here in the U.S. that we see is you only have so many dollars. How are you going to use those dollars across the same acres, right? You're going to plant the cheapest crop. Maybe you cut back on a couple applications, until if prices are high, then obviously you kind of throw the kitchen sink at it and try to get the biggest yield. When you get depressed prices and you can't justify a ROI, hey, if I do put, another $20 an acre down, is it going to pay back? And you don't know the answer, you might skip it. So I think those are the kind of things that will happen. And then maybe, right, stop the clearing of more land, right? So it's just kind of like our inflation is slowing. Well, it's not, it's still going up. It's just at a slower pace. So I think you'll see that first, to your point, before you just don't plant it. Same in the U.S., right? You might put some ground in CRP, or you might do some things here and there, or if it's a really crappy fringe acre, maybe you do something else with it. But generally, once the land's cleared, you're going to plant it.
Yeah. Yep. And so it goes back to okay, well, what are the production implications? If you're looking at, the cost of inputs, specifically labor that goes into everything that takes to grow an acre, especially in North America, it's at some point, the market does care about, maybe it's not this year, but the next couple of years, that the producer can actually make money before we start seeing severe changes in potential production. demand is not the only, market participant. It's definitely supply still too. So that's why I think, longer term, we look out, like ag is a fairly small market from the global economy, especially when it comes to like labor. Are we really thinking that, we're looking at, like, let's say, the back end of the market, D25 and D26 corn trading in the lower fours now, that you're taking a pretty big assumption with land values where they are, in my opinion, for the next 2 years to go put central Illinois ground, above $20,000 an acre, and then say, okay, well, for the next 2 years, that's going to be justified with the rental rates that can be afforded at current prevailing market prices and expected yields on that ground. Is it going to be that rents just suffer for a couple of years, land prices don't go down, and the market fixes itself in 5 years? Or is it going to be that land prices have to come down, rental rates have to come down, everything has to come back down to where we can all make money in a $4, $3 to $4 environment again as producers? Or is it something like what's happened with the rest of the world, is that everything is adjusted to the new denomination of the dollar, and really it's the output that's gotten too cheap, right? The value of these commodities, we're no longer farming for $2 corn bushel anymore, even though we've got record trendline yields, right? At some point, there's still a base for that dollar denomination that grows with that growing input cost. And it's hard to quantify. It certainly is something is beyond me, but I do think I'd be cautious on taking an opinion that we're in a bear market for corn, so therefore we should just sell the next 2 years of corn without knowing the cost of inputs. I think that's a very dangerous thing to consider. And you ask anyone that got a little bit too aggressive forward marketing in 2020, for example, or in late 2008, early 2009. You start marketing a couple years out after you get into a bear market, and a lot of times it turns out to be a mistake, especially in a situation where the dollar doesn't have any clear path of improvement, in my opinion, right? Like we are addicted to loose fiscal policy and loose monetary policy in this country, and the growing deficits that we have don't seem to be moving in any direction besides expanding.
Very good. Ben, what's on your mind this morning?
I think we're here. First placement day for commercials, first notice day on Friday. It's encouraging to see demand in some flash sales, but I think that we're in a supply situation where we need to continue to see that. I don't know that we've seen enough to spark a really aggressive rally yet. Typically, we'll see sales over an extended period. We had a nice run there in beans, and then we took a couple days off. Corn sales generally routine to Mexico, nothing too exciting there. And I think the next question is, when SEP goes off the board, does these roll down and suck the carry out, or has this been sort of a synthetic hammer on the price of corn as producers rid themselves of old crop? So that's just kind of where I'm at today. I think that wheat probably is a market that's done enough damage for now. It'll be interesting to see how it plays into first notice day. There certainly was plenty of wheat left on basis, as we had some pretty depressed prices there as we got into July. So we'll see how it shakes out. There's nothing here that tells us that we've seen any kind of a trend change. Corn did have a nice day on the chart, but this is the third key reversal corn has had in the last 6 weeks, and every one of them has been negated as we search for lower prices. I guess my longer term bias is I think we're going to have trouble really getting some significant footing as we approach a massive harvest here.
Yeah, just to add to that, I think all these things are related. Wheat, corn, beans, and it's elevator space. Yep. Right. And you see SEP Nove beans trading at what they trade 21. So 10.5 cents a month. So paying a big interest rate to take. So all of a sudden old crop beans have come to the market. They've been cleaning out probably wheat for storage space for corn, new corn harvest, old crop corn. I mean, I think all these things are related, flushing out this bad farmer long. personally. We talked about it a lot of times, but I think a lot of this is all related, and there's going to be a period, and I've said this a lot of times in different markets where I think we're close from a time perspective. I don't know what the price is, but I think we're close to working through the majority of this. Call it the next, between now and September 15th. When you get beaten up when you get beaten up in this old crop, if you were long a bunch of old crop corn and farmers had to sell it, generally, are they going to do the same thing and put a bunch of, DP bushels into commercials or pay these high unload rates to store commercially? I don't think so. So you're probably getting just a general flat price selling too, so it kind of compounds. You got to get these like cycles where, if I'm going to sell 1 year, I might as well sell 2 years of corn. And it's either kind of not sell anything or sell double.
Yeah.
Unfortunately, it's kind of the psyche out there in these cycles. So,
Well, I think that as we see this and we see these spreads widen out with cheap volatility, it's worth exploring what some of your alternatives are versus staying the course and just rolling, especially when you look, Sep to March is going to be 45-ish cents, right? So I think there's some things there that a grower can do that might have some advantages to it versus just rolling again and paying these really wide spreads to hold on for. I mean, at this point, I think that if you're rolling corn, you're banking on a real problem in South America. If you're just going Sep to Dece.
Yeah, and you have to have a really big rally just to break even.
Right.
That's the hard part. It's paying a dividend. It's not a dividend paying stock. It's a it's a dividend taking stock. It's a really tough uphill battle.
Yeah, I don't think there's any question. Sep corn is a position problem, right? The market is down to 26-cent carry as we open here from Sep to Dece. We're getting really close to full carry now at this point.
Well, full carry. So what interest rate would that be, Dustin?
About 30 cents would be.
Well, I'm saying at 26, you're earning 2 cents a bushel.
Right. Yeah.
Interest, right?
Yeah. So 2 cents a bushel, and we're talking, at 3 months, so times 4 divided by current price is 364. So that's a 2.19% interest rate.
Right. So these markets are trying to find an interest rate where investors will take it. These spreads, right? So, at that you're already paying 2% interest. It's some number. When we talk about full carry, right, we're talking about hypothetical full carry. That hey, I can earn more money stopping September corn and delivering against the December. I can earn more interest than if I buy a CD, right? So that's where you get to those levels. Just to be clear, and I think beans are doing the same thing. Wheat's doing the same thing. Wheat's a little trickier because of VSR and some complicated things there. But yeah, I would think corn, spread stopped somewhere around 28. There would be enough stoppers there to earn that interest rate and have a free call option basically and earn interest. But that's just I think this just shows the point that we're at. We have to get to a point that investors are willing to make a spec trade on an interest rate play because there's that much old crop corn being moved right now.
Very good. Ryland, real quick, second day yesterday of opening on the lows and then rallying sharply. We're a little lower again here to open this morning, but a couple thoughts on cattle.
Yeah, it's just been, you're right, that trend has been kind of obvious for the past 2 days, and it just seems like we haven't really seen any cash trade to back it up at this point. It just seems like there's been a little bit of just capital kind of moving around here. Overall, it seems like we still got a ways to go to test some of the longer term areas of resistance above the market. But there just hasn't really been much good news. And we did see choice beef down 393 yesterday. So it kind of feels like the Labor Day buy maybe kind of relaxing a little bit here. I mean, we know the seasonal has been good, but it's been a pretty sizable rally. It wouldn't shock me to see some profit taking or at least some hedging now that we've seen this kind of move, even though it feels like we're right off the bottom. So we'll see. It did seem like open interest did go up 2,500 contracts yesterday. So we are seeing that increase in commitment on the live side. Feeders, the managed money has been relatively short here, and so we saw open interest come down 910. It kind of felt like maybe we saw a little bit of covering, of those shorts on yesterday's price action. So I think a setback would definitely not surprise me at this point, especially just kind of waiting to see how cash shapes up. We're all really optimistic, but I think at this point there is this discount on the board that's everybody's staring at, saying, hey, are we going to actually see this cash trade start to drift lower into the fall? So I think that's something that just everybody's kind of keeping an eye on right now, and we're waiting for more information at this point.
Very good. Appreciate that, the insight there. We just came into the open. We got December corn down 1 3/4 now at 391. November soybeans are down 7 3/4, 978 3/4. And Chicago wheat, December is up 4.5 at 540. We appreciate, the write-in comments. It sparked a good conversation here this morning, so we're very appreciative of that. Throw us a like or subscribe if you enjoy the show. It helps us, opens up premium content, keeps you posted on and updated on everything that's going on with AgYield and the show. So we certainly appreciate every day folks that are tuning in, and we're having fun with it there. So throw us a like or subscribe. Doesn't cost you anything, and we appreciate it. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Thanks for the thoughts and comments here this morning, guys. It was a good show. We hope everybody has a great day, and we look forward to talking to you again tomorrow morning.
You as well, Dan.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.